Hi guys. Okay, so welcome to this evening's collab, and I'm recording it so you guys can listen to it again later and go through the answers to the questions in your own time. But I'm just going to go briefly through it with you together on screen tonight, and then you can ask any questions if there were any particular places that you were stuck. And then so yeah, the marking takes quite a while because it's a big group. It's a group of 50 students, so it will be some time still before you get your marks, before they are released. And please, when the marks are released for the assignment, you must log on to Learn and go and open up your marked assignment, because your marked assignment will be uploaded in your grade center. And then go through the marked assignment, because my comments and corrections and places to say you should have done this, or you should have done this, or this was good, is all going to be written there. And that feedback from me is very important for you to then have a look to see where you need to adjust for your next assignment, or comments as to where you could have got more marks, or what you did well. So please remember, when they are marked, I will let you know. Once I've finished marking the assignments, we then advise the national office, the National Results Center, and then they check and verify everything, and then they are the ones that then finally release the marks. So we've got to wait for them to do that as well. Okay, so we can just discuss the questions as we go through the paper, unless there's anything else that anybody wants to ask now. Anyone got any questions that you want to address before we start? Anything else that's on your mind? And remember, these are relaxed sessions, no formalities. You can open your microphone and chat. Put up your hand, or you can chat to each other or ask questions in the chat box on the side, and then I'll be able to pick up what you guys are going through there. Okay, so I'm just going to go and share my screen now so that we can have a look at the memo. Where am I here? Entire screen, share audio. Okay, so in a minute you should see that kaleidoscope effect, and then I'll be able to go over to the PDF. Okay. Okay, let me just make this a bit smaller. Sorry. And this one as well. My laptop has been so slow today, so I hope it's going to improve as we go through this. Okay, so how did you guys find the assignment? How did you guys manage? Did you manage? Did you get through everything? Was all of the help and the videos and lesson plan and everything that I posted for you beforehand, was that all in sufficient help for you to manage? Were you guys okay? So hopefully you guys have also seen the announcements that I've been posting this week. So now we're getting ready for assignment 2. So please follow along with that, with the pacer, and try and keep up with what I suggest you do, the work that you do each week, because in that way, you're going to be sure of giving yourselves enough time for each of the questions for assignment 2 as well. All right, so let's just have a look. Question 1. Excuse me. This one was where they gave you a scenario about a company that is a listed company. So that is important that they're listed, because then that means that we know that it is a public company, not a private company. And then they've been expanding, so that was an important bit of information. And they have up to now been using debt Okay, so that means taking out loans. So remember, in second year finance, you learned about the debt equity ratio and how to measure that and what it meant for the business. So they've been using debt to finance part of their capital structure because interest rates were low. So that means when interest rates are low, it's beneficial to use debt because it's not that costly. But then you've got this, however, things have changed as they always do in the environment. There have been increases in the inflation rate. So the Reserve Bank has increased the repo rate. So as soon as the repo rate is increased, that means that the commercial lending rates also go up. And this is exactly the financial environment that we've been in over these last years since COVID. We're currently at a very high interest rate level in South Africa. So the MDs expressed concern that the business is too highly geared. So again, hopefully from your second year finance, you remembered what gearing means and you understand your gearing ratios, and they need to look at alternative sources of funding. So expressing concern about their interest costs. Interest costs have gone up because we've got debt, but interest rates have gone up, and they're hesitant to lend further amounts to the company. So in other words, they need alternative sources of funding, but they don't want to use further commercial debt with interest rates in order to raise those funds. Or anyway, they can, but it's going to be difficult because the banks are going to charge them a lot of money for that. So the directors approached you to advise on other funding options, namely in the form of equity. So this was important. So not debt, but equity to help improve the company's gearing. So in other words, between the debt equity ratio, we want the equity component to increase versus the debt component of our capital structure. So there's even been discussion concerning delisting from the JSE and converting Awesome Limited into a private company. So all of that was background information, but you can see by the bits that I've highlighted that there's a lot of information there referring to content that you should already be familiar with from last year, as well as additionally what we've had a look at in your learning units this year in learning unit 1 in terms of the cost of capital. So then for 24 marks, you had to prepare a report. So when they say prepare a report for management, that just means your answer must be written in the form as if it was a written report being presented to management. I had a lot of questions about that, funny enough, not about anything else, but about, ma'am, what must my report look like? It just needs to be presented in the form of a memo. So you would then write your answer address it at the top. Report prepared for the managers or the directors of what's our company, Awesome Limited, from, and what did they say, we're a financial advisor or whatever it is, but just to show, and then your wording of the report would then be as if you were addressing the managers and the directors of the company, explaining to them exactly what we were asked here, which is that we need to discuss various ways that equity finance can be sourced. Okay, so this is what we had to explain, various ways that equity finance can be sourced in order to fund, and this was important, both public and private companies in South Africa. Okay, so remember it was both public and private types of funding. So you also needed to address, why does that keep popping up? Also needed to address both of those. And then in your report, focus on any advantages and disadvantages of using each of the sources. So in the required, they've basically explained to you exactly what they want. You need to list various ways. So in your textbook, there was a list, I think, of 6 different ways in which equity finance can be raised. So not list them, but discuss each of the 6 And for each of those 6, state what the advantages or disadvantages of each of those different sources would be. Because remember, you're giving this report to the managers so that they can use your report to make a decision. As financial managers, that is our main function, is to assist directors and managers to make decisions by giving them financial information and presenting that financial information in a way that they can understand easily and then refer to make decisions. You remember back also last year, you learned the difference between financial accounting and management accounting and what the two. So we basically here are doing management accounting, which is used for future planning in companies and decision making. And then, okay, let's just go and have a quick look at what sorts of things you could have had a look. So page 16 in your textbook was where they have got these different things, where they cost of equity, the heading cost of equity in your textbooks, and the various ways were listed. Okay, so 24 marks. So you can see here the marks were allocated as 6 times 4 marks. So 6 different ways, and there were 4 marks allocated to each of the different types of sources that we could have. So this basically comes out of your textbook. So I'm not going to go through this. Let me just take a quick look. I mean, I think this is probably, they're probably on this memo. Yeah, this is directly out of your textbook. Obviously, in your presentation, in your assignment, you need to have paraphrased, used your own words and explained, in other words, read it in the textbook, understood it, and then written it back in your own words as if you were explaining to the directors. So you would lose marks for plagiarism if you just copy directly out of the textbook as it is here on this memo. Remember, the memos are just for the markers to refer to understand what sort of information the students should have included in their answers. So have a look here. 1 mark for naming the source, and then a maximum of 3 marks for explaining the source. So you can see here 1 mark for stating retained earnings is one of the sources you could use. And then there'd be a maximum of 3 marks for your explanation, disadvantages and advantages of using retained earnings as a further method of raising capital. So we had retained earnings. There's a rights issue, a public issue, private equity finance, because remember they said public and private. So these last 2 are private equity. Private equity finance, crowdfunding is also private. And then corporate and institutional investors. Okay, so hopefully, and I did include those page references, I think, in your lesson plan. So it comes down to you presenting that answer nicely on your paper. Okay. Anyone got any questions on that particular, on 1.1? Anything you want to ask about that? Okay, hopefully that one should have been straightforward enough. So then the second question is discuss which type of risk Awesome Limited is currently facing. And then there's an and, so you had to do 2 things, and what assumptions the cost of capital makes in terms of this particular type of risk. So let's go back here. Okay, that's good. Thanks, Michelle. So hopefully by now that you guys have seen that when I'm doing these collabs with you and I'm going through questions either in past papers or in your assignments, you see how I always take a highlighter and I take a pen and I circle and underline and basically break down the question from the required to make sure I understand exactly what I have to prepare and present in the answer in order to get those 6 marks. Okay, so the 2 things you've got to do, you have to discuss which type of risk they are facing, and then secondly, what assumptions cost of capital makes in terms of this type of risk that you've identified. So our answer here is, hopefully you did manage to identify that it was financial risk as opposed to what other kind of risk could it have been. There's two risks that it could have been, financial risk, or what's the other type of risk that we've got that basically we discuss in Learning Unit 2. 2 types of risk, financial risk, or what's the other one? We've got, if you think of Learning Unit 2, you've got 2 types of leverage. And those types of leverage result in a different risk. If you use the form of equity finance from the internet, would we still get mark? Are you talking about for question 1, Mlungisi? Yes. If your answer is correct and it's logical and it fits in with the answer, you will definitely get marks. Yes. I will read through whatever you've written, and if whatever the student has written answers the questions, absolutely, it really doesn't have to come out of the textbook. So our 2 types of risk are financial risk. The other one is operating risk. Okay, so in question 1.2, they said which type of risk you had to identify, was it a financial risk or was it an operating risk? Please make sure you understand the difference between those 2, and you'll get all that information in Learning Unit 2. So financial risk, that's 1 mark for identifying that it was financial risk, and that describes the uncertainty surrounding the level of gearing of the company. In other words, the moment we've got debt in a company, in our capital structure, then that creates financial risk. Because why is it a risk? Because it then affects the company's ability to service its current debt obligations. Because remember, when we've got debt obligations, we have to be able to meet our interest payments as well as our capital repayments of the debt. And that's the risk that the company faces, that things could go wrong. Interest rates increase, our turnover decreases, and then suddenly we're battling to meet our interest payments and our repayments. So financial risk is the risk that Awesome Limited, and you should always refer back to your case study in your answers, okay? Because remember, they've given us a scenario. We are a financial advisor or financial management, and we are discussing this scenario with the management. So that's very important. You always get extra marks if you have linked your answer to the case study. Financial risk is the risk that Awesome Limited is unable to make the obligatory interest payments, their capital repayments, or to meet shareholder dividend expectations, which is also a financial. This dividend expectations is not mandatory. In other words, they're not obliged to do it, but it's not a legal obligation, but it's an expectation by the shareholders. So if they have cash flow issues, then these are things that risks that will arise. And then the key assumption is that the risk associated with the financing of any new project, because remember they said they want to raise the funds for a new project, equals the financing risk of the company's existing sources of financing. So this is the assumption we make, is that the risk of the new project is going to be the same as our existing sources of finance. And any new projects are financed in a manner such that the company's ability to meet its existing debt service obligations remain unaffected. So that is what they were looking for those 6 marks. But again, because it is an assignment and they're asking you case study questions, if you've answered and your answer shows me you've thought about it and you've mentioned a risk and you've mentioned other assumptions, you will absolutely get those marks. Okay, so your answers do not have to be verbatim like this from the memo. These memos are guidelines for us, and we are allowed to give you marks for anything that that could reasonably be taken as being correct. And then for 15 marks, they said, this one, I'm not going to go through that whole scenario here, but what they wanted here was describe to the board what are government retail savings bonds. And in your discussion, focus on, and then there were these 5 bullet points that you had to be sure to mention about government retail savings bonds. So again, you are describing to the board, so your answer should be as if you went and researched government retail savings bonds, and now you are explaining to the board of directors what they are, how they can access them, what type of bonds are on offer that they could possibly apply for, conditions, benefits, and all of this. So your answer should be in, the conversational isn't the right word, but in the format as if you in your own words were explaining this to somebody else. The reason that they ask the questions in this format is that this is one of the very best ways for you guys to do your revision. I don't know if you've seen that. I did speak, I think, in one of the last collabs about the blurting method when you study. So the blurting method says you go to your textbook and you go through all the content and all that technical detail, and you make your study notes or your flashcards, and you learn from that. And when you've learned it, in your own words, you explain it to somebody else. And usually it's best to actually do that out loud. And as soon as you can do that, talk as if you were explaining it to someone else out loud, then you know you've understood that concept and you are ready to answer a question. Remember, in the exams, you're going to have to be closed book, so that's the way to practice those exam questions. So this question was entirely research-based. There's nothing about this in your textbook. So as you can see here in the memo, it says students would need to do their own research. Most information can be accessed off the Retail Savings Bond website. So hopefully you all found that. Anywhere else as well, as long as it is for South Africa, remember. It's strange how often I get students will then give me answers about American financing, or the answers are all in dollars that they've taken off the internet. Remember, always relate it back to the question and the case study you've been given. We are in South Africa, and that's what they're asking us. So the marks were allocated 3 marks for discussing what a retail savings bond is. So kind of like a definition of what it is. 2 marks for where and how it can be accessed. 4 marks for conditions that apply. 3 marks for benefits, and 3 marks for current returns versus inflation. So that was all research that you had to do. And the marks are broken down like that. So all of that information has to be there in order to get those various marks. And remember, they did give you those 5 bullet points. So if you've left out any of the information for one of those bullet points, then you won't get those marks, even if everything else you wrote is correct and beautifully presented. And then very important, and I did remind you about this often in our before the assignment, is always remember to provide your references. Anybody got anything, any worries about that question? How did you guys go with that question? How did you guys find that information easily enough when you were doing your assignment? Okay, did anybody battle to access that information? You all managed to find that on the internet? No one battled? Okay, awesome. Back to question. Okay, so then the last 2 questions are the calculations that you had to do. So that question 1 was almost half of the paper. And then question 2 for 30 marks and question 3 for 25 marks. So question 2 is the one where the required is calculate the EPS for Yorker under both options of either continuing production with the current machine or instead upgrading to the new one. So I did go through a past paper that was a very similar question to this so that you guys could see what the format of your answer should be, and also showed you in the textbook where you've got similar questions. So hopefully you had a good idea of what to do. So what we had to do here was, let me just go to, just take a quick read through this question so you can refresh your memories. I don't know, hopefully you've got your assignment papers, question papers with you, and you can refer to them. We manufacture soccer balls, awarded a contract. Okay, so we need to basically expand our production. Information that they gave us, each ball has got a variable cost of 60 Rand and has got a contribution ratio of 60%. So this was the first bit of information that you had to use to then work out what the selling price of your soccer balls is. Okay. If the contribution is 60, because we know what our little formula is. Selling price is made up of, we do it this way around, contribution margin is our selling price minus the variable costs. So because we know that, we can then work out that the selling price is going to be made up of the contribution margin plus the variable costs. So that's just very basic logical math. So now what have they given us? They've given us the contribution ratio and they've given us the variable costs. So with the contribution margin and the variable costs, we can then calculate the selling price. So if the contribution ratio is 60%, that means the variable cost ratio is going to be 40%. So if 60 Rand is 40%, 60 divided by 40 times 100, we can then work out that the selling price will be 150 Rand. Okay, so that was the maths that you had to do there. Then they gave us 75,000 balls are manufactured and sold per annum, and here we've got our fixed costs. And there's our quantity. Because remember, this is per ball, selling price per ball, and that's the number of balls. Here's our capital structure. So remember, when we're working out EPS, we start at the top with our revenue or selling price multiplied by quantity. Then we deduct the variable costs in order to calculate a contribution margin. Then from the contribution margin, we deduct the fixed costs to get our net profit. And then from the net profit, we then have to deduct any interest costs from debt. And we then get attributable earnings. And then from the attributable earnings, we then deduct preference share dividends and dividends to ordinary shares if there are any as well. We can then work out the EPS. Once we've deducted the value that has to be paid to the preference shareholders, what's left over can be divided by the number of ordinary shares to calculate the EPS. So that's what all of this information was to be used for. So our new machine was going to cost 6.5 million. And then remember, we must determine, so this is the problem that we are assisting the directors to answer, should the company replace the current machine with this new one or not? And then we went over all of the stuff in the NSS before the quarter, etc. So I'm not going to go through the rest of that question again now. You've got the question paper. So let's have a look at what the answer was. So you had to, you could have done in the question that we gave you, we had these, the lines that we had to have down the left-hand side. Sales minus variable costs equals contribution, minus fixed costs equals EBIT, EBIT minus interest equals PBT, minus tax, profit after tax. Then we pay the preference dividends. That leaves us with the attributable profit divided by the number of shares equals the EPS. So those line items is going to be the same for both scenarios. So you could have done them next to each other. On this memo, they've just done them one underneath each other. And then you had to do it for both scenarios. So for the current scenario, which means with the machine that we've got now, before we have expanded our quantity. So what we've got here is 75,000 balls are currently made, multiplied by the selling price. So this is the calculation to get the 150 Rand selling price, what I just explained to you. So we can then calculate the gross revenue, the sales. Number of balls multiplied by selling price. Then the variable costs they gave us has been 60 Rand per ball. So you had to take quantity times the variable cost to get the total value of variable costs. That left you with the contribution. Fixed costs was given. So that takes us down to EBIT. Then the interest you had to calculate from the loan information that they gave us. So they told us we've got a loan for 4.250 million Rand that we are paying 13.5% interest on. So we can calculate the Rand value of the interest that we are paying. Deduct the interest. Remember, you must always indicate clearly when things are being deducted in brackets, or say less interest, less fixed costs, so that it's very clear what calculation that you've done. So that then gives us our profit before tax. We're down to profit. Then we have to deduct tax, which they told us was paid at 28%. So whatever value you had there, as long as you multiplied that by 28%, and that was the value you deducted for tax. And then we've got profit after tax. So the next thing that has to be deducted in our capital structure is they told us we have got preference shares. So preference dividends are always have to be paid first before we then finally compensate the ordinary shareholders. So our preference shares, they said we've got 600,000 preference shares. Currently trading at 15 Rand per share, which is at a discount of 5 Rand to their nominal value. So again, in the NSS, we calculated the nominal value of the shares is 20 Rand. And remember that the preference dividends must always be paid as a percentage of the nominal value of the share. So 9.5% times 20 Rand times 600,000 shares. So the total value of the preference dividends that we have to pay out is then the 1140. Deduct that from the profit, and that leaves us with the profit for the year, which is profit attributable to ordinary shareholders. We divide that by the number of ordinary shares in issue, 400,000, that was given to us. And then that gives us 1,848,900 divided by 400,000 equals 4.62 Rand. So that is the EPS under the current conditions. Anybody got any questions on those calculations? Anything there that you didn't follow or you didn't get or you battled with when you were doing the assignment? Okay, awesome. Thanks, Lungisi. And Michelle, also all good on your side. Okay, cool. So then let's go and have a look at the proposed one. So all we had to do for the proposed one was do the exact same calculation, but just adjust any of these lines where things would change if we were to purchase the new machine. So what was going to change? Number one, our quantity of units would increase because we would be able to make more units if we bought the new machine. We could increase output by 300 balls per month. Our variable costs per ball was going to stay the same, and the fixed costs was going to stay the same. Sorry, the variable cost was going to reduce by 30%, but our fixed cost was going to stay the same. And then because we were going to raise part of the money to purchase the new machines through partly through debt and partly through additional preference shares, our interest line is also going to change because the total rand value of debt is going to increase, and our preference dividend payout will also increase because our total number of preference shares in issue is also going to increase. So let's go and have a look what that looked like. So here we've got our current 75,000 units increased by, so it's plus 300 times 12 months. So we're going up to 78,600 per annum soccer balls. Selling price stayed the same, so that gives us our new revenue. They said variable costs decreased, but remember you have to calculate your variable costs for the new quantity. So the 60 rand must now be multiplied by 78,600 units, and then we deduct 30% because they said it would decrease by 30%. Sorry, let me just check if I read that the right way around. 60 rand minus 30% because variable cost per ball is decreasing by 30%, and then that value times 78.6. But you'll come to this, the rand value will be the same whichever way you do it. Okay, so again, sales minus variable cost equals contribution. Fixed costs unchanged, so we've got our new EBIT, and then our interest is going to also be changed. It's going to be increased. So here's our original loan that is existing. So that must stay there because that doesn't go. It's an existing loan that we still have to service, but now we have got an additional loan, which was the price of the machine, 6.5 million, times 25%. 1/4 of the price of the machine was going to be financed by the loan. So that's how we calculate the increased value of the loan, and we are still paying 13.5% on the total value of the loan. So our total interest is now increased to 793125. So minus interest equals our profit before tax. Then that profit times 28%, we deduct tax and we get profit after tax. And then we had to work out the new preference dividends. And if 1/4 of the cost of the machine was going to be financed by the new loan over here, 3/4, the other 3/4 then has to be raised by selling preference shares. So here's the 6.5 cost of the machine times 3/4. So we have to raise 4.875 million by selling new preference shares. We are currently selling them market price of 15 rand. So you have to divide that by 15 rand to work out how many shares you managed to sell, and then taking that new quantity of shares and adding them to our existing 600,000. We now have 925,000 preference shares, and to work out the rand value of the dividend that we pay, we have to multiply those by 20 rand times 9.5%. So you had to use the 15 rand to work out how many shares you had to sell in order to raise 4.875. And then your total new number of shares times 20 rand times 9.5% to work out the value of the dividend that you are going to pay out. Because remember, the dividend is always paid out on the nominal or par value of the share. And we use the market price of the share to work out how many shares we sold. And then the rest is the same. That gives us then profit for the year. And the new profit for the year divided by the number of shares, which was unchanged at 400,000, gives us R5.81 EPS. So in this question, they said calculate the EPS for both. They didn't ask for a decision, but I mean, I'm sure most of you probably wrote underneath here which option. So we've got currently, whoopsie, where did it go? Currently, we are getting R4.62 EPS, earnings per share. And if we did the investment, we would get an EPS of R5.81, which is obviously better. So yes, the company should go and do the investment in the new machine because the EPS will increase. These questions are always easy when you see them worked out afterwards. But hopefully you're following all of the steps and you understand what was done. Anybody got any questions with the second scenario? You guys all happy with that? Okay. And then that just leaves us with the last question, which was the WACC that you had to work out. And again, you had examples. I gave you examples of what to do. So in this question here, we're Alcaraz Limited, currently preparing analysis. Okay, we've got the company's capital structure, and we've determined the following. So they've got three types of sources that make up their capital structure. They've got ordinary equity, preference shares, and debt. So the required was we had to calculate the WACC using the market value method. And this one wanted you to advise them whether they should go ahead with this investment proposal or not. And there was a rounding instruction. So let's just take a quick look at what the structure of this answer would be. So what I always suggest is to say you go and write down your table, your WACC table, because this is what you need to fill in. So write it down, fill in what you've got. We know we've got three elements: ordinary shares, preference shares, and bonds. And this is market value. Okay, it's just typos on the memo. Market value. So for each of those, using the information they've given you, go to the right page here. So for your ordinary shares, again, you need to know what let's see, what did we have here? Ordinary share capital is reflecting at 70 million. The shares are currently trading at a discount of 20%. So in other words, their current market value is only 80% of their par value. So that was why we took the 70 million, which is their par value, times 80%, because they're currently trading at a discount of 20%. So that's how we got the 56,000. Preference shares, we've got 8 million preference shares. And I did the calculation for this 22.50 Rand with you in the NSS. Hope you remember, because our preference shares are paying 9% and the market rate is 6%, the market price would then be 9/6 times 15 Rand. So in other words, we can sell our preference shares at a premium. their nominal value is 15 Rand, but because we're paying 9% and the market is only paying 6% interest, we'll work out the market price of the share as 15 Rand times 9/6. That's where the 22.50 Rand comes from. And they told us we had 8 million shares. So that gives us the market value of the preference shares. And then our bonds, which is the debt, they told us we had 5,000 bonds times, I haven't got the calculation for that right now. I can always put it for you in announcements. I haven't written it down here. Market value of the bonds, the workings will be further up there. We'll go and have a look in a minute. So you add these three market values together to get the total market value. And then you work out the weighting of each of those of the total. So 56 million over 269,383 is 21%, etc. And then the cost for each of these three, you have to work out the cost. And then it's weighting times cost equals the WACC, the weighted portion for each source, and then you add those up to get the 6.49%. And then the decision is accept the project because the cost of 6.49% is less than or lower than the return that the project is going to give us, which is 15%. So they told us the project is going to generate a return, internal rate of return of 15%. So as long as our cost of capital is less than 15%, there will be profit in it for us. So that we can say, yes, go ahead and do the project. So here's your cost calculations. Where are we here? Cost of equity. This was our CAPM formula. So RF, what have they got here? Yeah, times, which is the negative, the beta was, sorry, I'm just trying to read the question at the same time. The beta for the share was a quarter of the market beta, moving in the opposite direction. So the minus 0.25 is our beta. So RF minus beta times RM minus RF, and the RM and the RF were given to us. Okay, so that's just the CAPM formula. Cost of preference shares. Here is the calculation for the 22.50 Rand, which is the market value. And then the cost is then market value minus flotation costs. So 21.38 will be our net proceeds on the issue of the preference shares. So nominal value times the 9% dividend that we have to pay over net proceeds equals the cost of the preference share. Because remember, for a preference share, RP equals DP over NP. That's the formula. Dividend, 15 times 9% over NP, which is net proceeds. So that one wasn't too difficult. And the cost of the bonds, they told us that the before tax cost of the bond was 14%. So we take off the tax of 0.7, take off the tax. So that means with the tax shield, our actual cost is 10.08%. And here's the calculation for the market value of the bond. The present value is 8,000 Rand because that's the nominal value of each bond. The PMT is going to be nominal value times the coupon rate, which is 16%. These are 10-year bonds, so N equals 10. Paying dividends once per year, and then IY is 14, because they told us that the before tax cost of the bond is 14%. And then we go comp PV, and we get, sorry, this over here should be FV, not PV, future value. Okay, so that's just another typo. So future value is 8,000 Rand. In other words, that's the maturity value of the bond. The PMT, nominal value times the coupon rate. It's 10 years to maturity. 14% they gave us as being the cost of the bond. And then we go comp PV, and that gives us the present value of one bond. And that was where we got that 6676 times the 5,000 bonds there. Okay, so that was our question number 3 and the WACC calculation. Very nice questions this. It was a very nice paper. And I think it would have, challenged you, but hopefully you guys learned a lot in working your way through these 3 questions, that those 2 learning units, that you guys understood them, and you've learned a lot about those 2 learning units in doing that assignment. Anybody got any other questions that they want to ask about this? Anything else that we've done? Okay. Cool. Okay, guys, so I'm going to stop the recording, and then I'll post this recording for you so that you can go through it in your own time, because some of it I know we've got to go through it quite quickly, and you'll be able to go through it. And if there were any bits and pieces where you compare it to your own paper that you looked at, you can now go and compare to see, go and see where you went wrong. Okay, so just for future, I posted that pacer for you today. So our next collab that we have will be a general collab where I'll probably pick past questions from past papers and go over those again, or do something like that, record something like that for you in the collab. But then we'll obviously moving on now to the next lot of learning units, which are the learning units that you need to master for your second assignment. So our next collab is going to be on the 20th of September. So I'll go over some past papers that relate to those next couple of chapters, questions like that. Okay. And then we'll have the NSS on the 28th of September, which again, we'll go over more questions and go over the assignment too. And then on the 9th of October, your second assignment will be due. All right, guys, thank you very much for popping in and listening. I hope this has been helpful. And you'll have your assignments back probably sometime late next week. I'm imagining it will all be done. And then you can go through them and see how you did. So I'm holding thumbs for your marks, that everything is all good. And whoopsie, what did I do there? We are still here. Yeah. Okay, so let me just stop the recording.